The problem with short selling is it's something that, even though it's perfectly legal, it's something that people have a degree of discomfort with. You know, it's almost perceived as un-American to bet against a company. And we, by the way, only do it in very rare circumstances, and generally only when we believe when it's good for America or good for the world for the company to disappear.
The problem with shorting stocks is that there are going to be some large number of people who own the stock who are not going to be happy, and the CEO of the company is not going to be happy with you.
There's nothing evil per se about, in my view, about selling things short. I would say that it's a very, very tough way to make a living. It's not only often painful financially, it's very painful emotionally, because a stock that you sell short, a stock that you buy at 20 can go down 20 points, and a stock that you sell short at 20 can go up an infinite amount. And you don't think about that until you've gone short and it goes up about 10 or 15 points, and then you don't sleep very well. So it's a very tough way to make a living. There are people on the short side that have done and that do things to try to make stocks go down, some of which are appropriate and some of which are inappropriate. There are people on the long side that have done the same have the same sort of things go on. So I don't see any, I have no axe to grind in the least against short sellers. And in terms of what they call naked shorting, which means that you don't have the stock lined up to be borrowed, and maybe you have a whole bunch of fails to deliver and that sort of thing. I don't have a great problem with that. It's a very tough psychological game to play. Few people may be well suited for it. I would never put any money with a short fund, but not because I would think it would be ethically wrong. I just think that they're unlikely to make money. Charlie, do you have any thoughts on short selling or naked short selling?
Well, I think you're absolutely right there in the sense that that would be one of the most irritating experiences in the world, to figure out something is crooked and foolish and so forth, and then short it at X and have it go to 3X. Now you're watching all these happy crooks splashing around in your money while you're meeting margin calls. Why would you want to go in hailing distance of an experience like that?
It's an interesting item to study, because it's ruined a lot of people. It is the sort of thing that you can go broke doing. Bob Wilson, there's famous stories about him and Resorts International. He didn't go broke doing. In fact, he's done very well subsequently. But being short something where your loss is unlimited is quite different than being long something that you've already paid for. And it's tempting. You see way more stocks that are dramatically overvalued in your career than you will see stocks that are dramatically undervalued. I mean, it's the nature of securities markets to occasionally promote various things to the sky, so that securities will frequently sell for 5 or 10 times what they're worth, and they will very, very seldom sell for 20% or 10% of what they're worth. So therefore, you see these much greater discrepancies between price and value and on the overvaluation side. So you might think it's easier to make money on short selling. And all I can say is it hasn't been for me. I don't think it's been for Charlie. It is a very, very tough business because of the fact that you face unlimited losses, and because of the fact that people that have overvalued stocks, very overvalued stocks, are frequently on some scale between promoter and crook, and that's why they get there. And once they're and they also know how to use that very valuation to bootstrap value into the business, because if you have a stock that's selling at 100 that's worth 10, obviously it's to your interest to go out and issue a whole lot of shares, and if you do that, when you get all through, the value can be 50. In fact, there's a lot of chain letter type stock promotions that are sort of based on the implicit assumption that the management will keep doing that. And if they do it once and build it to 50 by issuing a lot of shares at 100 when it's worth 10, now the value is 50, and people say, well, these guys are so good at that, let's pay 200 for it or 300, and then they can do it again, and so on. It's not usually quite that clear in their minds, but that's that's the basic principle underlying a lot of stock promotions. And if you get caught up in one of those that is successful, you can run out of money before the promoter runs out of ideas. In the end, they almost always work. I mean, I would say that of the things that we have felt like shorting over the years, the batting average is very high in terms of eventual. They would work out very well eventually if you held them through. But it is very painful, and it's in my experience, it's a whole lot easier to make money on the long side. I had one situation, actually an arbitrage situation, when I moved to New York in 1954, so it was in about June or July of 1954, that involved a surefire type transaction, an arbitrage transaction. It had to work. But there was a technical wrinkle in it, and I was short something. And I felt like for a short period of time, I felt like Fanova was feeling last fall. I mean, it was very unpleasant. You can't make, in my view, you can't make really big money doing it because you can't expose yourself to the loss that would be there if you did do it on a big scale. And Charlie, how about you?
Well, Ben Franklin said if you want to be miserable, during Easter or something like that, he says borrow a lot of money to be repaid at Lent or something to that effect. And similarly, being short something, which keeps going up because somebody is promoting it in a half-crooked way and you keep losing and they call on you for more margin, it just isn't worth it to have that much irritation in your life. It isn't that hard to make money somewhere else with less irritation.
It would never work on a Berkshire scale anyway. I mean, you could never do it for the kind of money that would be necessary to do it with in order to have a real effect on Berkshire's overall value. So it's not something we think about. It's interesting, though. I mean, I've got a copy of the New York Times from the day of the Northern Pacific corner, and that was a case where two opposing each owned over 50% of the Northern Pacific Company, Northern Pacific Railroad. And when two people each own over 50% of something, it's going to be interesting. And Northern Pacific on that day went from 170 to 1,000, and it was selling for cash because you had to actually have the certificates that day rather than the normal settlement date. And on the front page of the New York Times, which incidentally sold for a penny in those days, it's had a little more inflation than Coca-Cola, front page of the New York Times, right next to the story about it, it told about a brewer in Newark, New Jersey, who had gotten a margin call that day because of this, and he jumped into a vat of hot beer and died. And that's really never appealed to me as, the ending of a financial career.
One of the things I hear often from people is, well, I don't like to short stocks because they can go up to, infinitely, but they can only go to zero. And I, of course, always point out that I've seen many more stocks go to zero than go to infinity. So, but you alleviate that like any other investor would through portfolio structure and risk parameters, which become paramount on the short side. But again, it's part of that behavioral thinking where they look at short positions often discretely as individual ideas, but yet most people will look at a portfolio as a portfolio. And they think differently when it comes to the short side and the long side. And we try to take advantage of that.
Now our bad days, we have hundreds of stocks on the long side and hundreds of stocks on the short side. We're trying to be right on average. We're buying cheap, good companies. We're shorting companies that are either destroying capital or losing money or whatever it is. Mm-hmm. And over time, that pays off. But our bad days with hundreds of stocks on the side are 20 or 30 basis points of underperformance, not 20 or 30% of our net worth. And so I think for most people, it's a smoother ride.
Yeah, the way you deal with unknown unknowns, which there are an unknown number of, but certainly exist, right? is through portfolio construction. We like to run a concentrated portfolio, but even our best idea, we're not going to put all of our money in. So you have to set some kind of a limit. You have to have some kind of a risk management. You have to have some level of diversification. We have some amount of longs and some amount of shorts, and so depending on, we have a certain amount of market risk that we're willing to take on a knowing basis.